I looked at a 20-year-old in an aggressive fund. Let's say they've already bought their home or they don't intend to buy the home. If they're contributing 3%, they get their balance by age 65 to 452,000, which is a reasonable amount. It's a good amount of money, right? If they can contribute 4%, their balance gets to 525,000 by age 65. If they can do 6%, 670,000, 10%, 960,000. So it's material. Each 1 or 2% more you can contribute over time with the power of compounding and great returns on top of that can make a significant difference to the quality of your retirement.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got Murray Harris, head of KiwiSaver at Milford, here to talk about KiwiSaver 101, 5 tips for the not-so-savvy KiwiSaver starter.
We're back in your life, and we've got Murray back for another episode. Welcome.
Great to be here again. Thank you, guys.
So today, in the last episode, probably got like a little technical. Today is not for those people. Today is all about KiwiSaver being an awesome tool to help you set yourself up for the future. But for those who aren't the finance bros like us talking about it every day, it can be a confusing world.
Yeah, absolutely it can. I mean, and traditionally, I think that is the fault of the finance and investment industry, right? It's opaque, a lot of big technical terms, jargon, and a lot of the times, historically, quite a while ago, I think that was used to maybe hide some of the reason that people were charging some fees. However, we are going to break through that opaque glass window, and we're going to talk about some tips for some not so savvy KiwiSaver investors. So, Murray, let's start at the top. KiwiSaver funds, what are they and what are the different types?
Well, there's lots of choice, but at its core, you've got a range of funds that start from low-risk cash funds that are invested in sort of bank deposits and cash-type investments, through to higher-risk funds like a growth and an aggressive fund, more invested in shares. And now we're starting to see some quite specialist funds coming through and sort of investments in cryptocurrency and Bitcoin and those sorts of investments. But at its core, most KiwiSaver funds are a diversified fund investing in a mix of shares and bonds and cash across the risk spectrum, from cash through to conservative, balanced, growth, aggressive, and then your specialist funds. And a KiwiSaver fund will have exposure to 200 or 300 or maybe more, maybe thousands of individual securities, but they're a managed fund essentially, run by either an investment professional as an active investment strategy or put together with a passive strategy with exposure to markets and indexes that fit the profile of the fund. So, a typical growth fund, 80% in sort of share market investments, 20% in fixed income or bond investments.
Yeah. And why should people care about this? And I'm gonna tee up a question here. Murray, tell us about first home buyer withdrawals last year. What is the number for that? Because when I heard this, I was like, oh my days.
Well, actually, one of the great things about KiwiSaver is, primarily it's a retirement savings scheme, right? That's its whole purpose. But when Michael Cullen put it together, he allowed young people, well, not just young people, but people who were wanting to get on the property ladder to buy their first home, to get some of their get all their KiwiSaver out, to get on that property, to help fund their deposit for their first home. I think that was a really smart decision because it's got a lot of young people interested in KiwiSaver. Otherwise, imagine talking to a 20-year-old when they start their first job. Hey, do you want to open this account? Put some money in it and you can get it back when you're 65. No, thanks. I'll worry about that when I'm in my 50s, right? Yeah. But you say to them, you put some money in here, your boss is going to put some money in as well, and then the government will put in $500 a year if you've put in more than 1,043. Are you in? And you can take some of it out to buy your deposit towards your first home. Young people are going, yeah, I'll have that. So last year, $1.2 billion was withdrawn from KiwiSaver funds to get people on the property ladder. The average withdrawal, $34,000. So that's significant. And you imagine if you're going into a house with a partner who's got the average balance, there's $70K towards your first home deposit. Fantastic start.
Yeah.
That's most of the way there, right? Like if you're buying a property for like $1 million with a 10% deposit, you're not far away.
Oh, absolutely. Yeah. So one of the key considerations when people are picking funds or providers is their age and stage. What type of fund should someone be looking at in their 20s versus someone in their 60s?
Yeah, that's a good question. And it's actually a personal question because it really depends on their personal circumstances. So there's three things to consider. What's your goal? What's your time frame? And what's your risk appetite? So, for a 20-year-old, it might be appropriate if they've already owned their own home or they don't intend using their KiwiSaver for a first home to have their money in a very aggressive fund because it's like a 40-year investment. So set and forget. Take as much risk as you can. And I should point out, I'm not a financial advisor, so this is not financial advice. But if you are going to use your KiwiSaver for a first home, let's say next year, then you don't want to be exposed to markets that could be falling when you want to pull your money out. So, a more conservative, maybe a cash or a conservative fund would be appropriate.
Yeah.
Similarly, though, for a 60-year-old, within 5 years, or in 5 years, they're going to be able to access their KiwiSaver. They might be thinking, well, I'm going to start spending that money. In 5 years' time, I'm going to start reducing. They may have been in a growth or an aggressive investor throughout their time in KiwiSaver. I'm going to start reducing my risk because I need that money at age 65. I don't want the risk of a market fall impacting my balance the year before I'm about to draw on it. So they might reduce from growth to balanced or a conservative strategy. But if they're saying, hey, I don't need that money at 65, I'm going to keep it invested for another 10 years, then it could be wholly appropriate to remain as a growth or an aggressive investor. So look, it really depends on their personal circumstances, and this is where advice becomes really important for KiwiSaver.
Yeah, I mean, I've got clients who are 23 who are in cash funds and 65-year-olds in aggressive funds. Like, you're right, they're good general rules, but there's nuance around it all. And the other piece as well, coming back to the financial literacy, education, understanding what will happen over time, is people will the risk is people start chasing returns, right? So you look and you go, share market's gone up 30% over the last 12 months. Aggressives made lots of money over the last year. I want a piece of that. And then they chase that. Then the market drops and they go, oh, I don't want that. I'm going back to cash, right? And I mean, COVID, I don't know if you've got any stats on this, but COVID was a really good example of the amount of people who didn't understand that markets will always go up and down as long as there are markets. And if you move from aggressive to cash, you're crystallizing your losses. It's the same as like house prices at the moment, right? Like house prices have dropped, but it doesn't impact your life unless you sell the house.
Yeah. Actually, that's a good point on COVID. We did see a lot of switching across the KiwiSaver industry in March. As the pandemic was starting to gather pace and people were panicking, we saw, I think, stretching my memory banks here, but I think it was somewhere around 1.4 billion out of KiwiSaver. And at that time, I think KiwiSaver was well below 100 billion. It might have been 70 billion. So quite a lot switched to cash. And then, of course, markets bottomed end of March, sharp recovery. We know a lot of that money never went back. And some that did went back very late because people tend to wait for the recovery to think, oh, the market's safe, I'll put it back in. They've done themselves a lot of financial damage. Compound that over the next 20, 30, 40 years, the impact on their retirement will be significant, literally tens to hundreds of thousands of dollars.
Yeah. And I can't remember the stat off the top of my head. It's something like if you miss the best 20 days of the market in a year, you're half your return or something, right?
Yeah.
So if you're chasing ups and downs and you're getting the worst and missing the best, it's going to have a huge implication over a long period of time.
So it's time in the market, not timing the market. And if you try and time the market, retail investors, I mean, even professionals don't get it right every time, but your mum and dad investors typically sell at the wrong time and buy at the wrong time, and it costs them in the long run.
Yeah, and I think it's a little bit tricky, right? Because Kiwis, we're hands-on people. We want to be doing stuff, right? And it's one of those weird things where the more you leave this alone, the better it's going to be.
Yeah, it reminds me, I need you to pop over on the weekend and help me fix a fence.
Yeah.
On my property.
You think he's joking. He's not.
Yeah. We got to talk about this afterwards.
Yeah. So in terms of the way that contributions happen with KiwiSaver, everyone knows, right? A clip comes out of your pay packet, your employer throws in a bit as well, and the government tops it up. What's the sort of baseline KiwiSaver contribution in New Zealand, and what percentage do you think that people should be contributing?
Yeah. Well, the baseline contribution rate's 3%.
Yeah.
And
too low?
Yes.
Yeah.
Way too low. Let's come back to that point. So you put in 3, your boss puts in 3, your boss's portion's taxed, right? employer superannuation contribution tax. So it's actually about 2.5%, which is why you see on your pay slip your boss's contributions are a bit lower than yours. Maybe we need to review that. So 3% plus 3%, it's more like 2.5%, so 5.5%. If we look at the most successful superannuation systems in the world, people are saving around about 10% of their income. You look at Australia, 3.8 trillion, going to $6 trillion of superannuation assets by 2030, I think it is, or might be 2040. They're saving 11.5% of their income, going to 12 next year. So we're a long way behind. It's a great start, but we're a long way behind. So I think in New Zealand, KiwiSaver has been very successful from a participation point of view. So there's 3.3 million people in it, very high participation in the 25 to 44 year age bracket. So those that can benefit the most, I think it's in the high 90%. 80% of the working population are contributing, but 1.3 million Kiwis are not. And that's probably children and retired people. But most people, three quarters of members are doing the minimum 3%. It's not enough to get you to where you need to be to live the retirement you dream of.
Yeah. So if we gave you the magic wand and you could make some changes to KiwiSaver, because there's lots of things you could do, right? Mandatory contributions, higher contributions, the whole thing between like you put in 3, your employer puts in 3. There's some employees in there that like bake it all together and then it makes the employer
Total REM,
which is just like
we got to get rid of that.
Yeah, and it just gives the wrong vibe to your staff as well that you're trying to rip them off. So like Australia is just like a total percentage. There's tax advantages to like first in Australia, if you put things like 15,000 or something like that, you get like some tax advantages.
Contributions are taxed at 15 rather than here at your marginal tax rate.
Yeah. So if you had the magic wand, what are we going to do, Mark?
All of that.
Done.
Right, easy.
Why reinvent the wheel?
No, I mean your contributions is the key thing, right? So we need to get people into saving more. But at the moment at 3%, the government says do 3%. So what do people think? Oh, I'll do 3%. That's all I need to do. That's what the government's told me to do. I'll be set.
Yeah.
So I think we need to review that and maybe consider contributions incrementally increasing every year by say 0.5%, because then it just becomes a habit.
Doesn't have to happen.
It comes out of your pay packet. You don't notice it. And then, you might get it to say, 5 or 6%, and then maybe an increase from the employer as well. So that combined, we're getting closer to 10%. We have to be conscious though that, employers have been through a pretty tough time. We've had COVID and then we've had recession and we've had high inflation and high interest rates and all that sort of stuff. So we've got to be careful not to put too much pressure on employers to make those payments. So this is where I think the government comes to the party and says, hey, quid pro quo here. We want employers to help fund their employees' retirement. We want employees to help fund their own retirement. Let's provide a little bit of tax incentive here. And that could be like Australia, where you've got incentives around lower tax on your super contributions than on at your marginal tax rate. For an employer, it could be some sort of tax rebate or offset for making those contributions. So we need to get contributions closer to 10%.
Do you know who is another market who I think is very underserved in the KiwiSaver space? Business owners, self-employed people who aren't salaried, because they look at it and they go, well, I don't get the employer contribution, so I'll just put the $100 a month into KiwiSaver to get the government tax credit. The only problem is, they're thinking about this in terms of the stats around, then I will take that money and go do something else, but they'll go and spend it on something and they will get to retirement and they won't have their pot of money to do anything with. What can we do for the self-employed people out there?
Oh, I think the same, some sort of a tax benefit or an incentive to say, hey, if you put more into your super, then there's some trade-off for that, so that you are helping to fund your retirement pool, and that's less of a strain potentially on the government in the future to fund those retirees.
Yeah, Mike, once we crack this this kind of financial services game, I'd love us to get into this and whole just lobbying for these sort of changes. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website. So one of the key differences, I think, between the New Zealand super funds and the KiwiSaver providers and the Australian super funds is the ability for some of those Australians to self-manage. Now, we talked about it a little bit before. Kiwis love DIY investing. Do you think this, and some of the players in New Zealand are starting to do it. Do you think this is something that is a good idea, or would you just go, look, you know what, you don't know what you're doing, keep your hands off?
Well, even in Australia, self-managed super funds were quite niche, and it was quite a small proportion of the population that were doing it, and they were mainly because there were some tax benefits, and a lot of people were putting their house and their wine collection and their art and their classic cars into their super fund, and there was some tax benefits. So it's quite a different market.
It'd be fun to see the performance of like a wine collection, car
collection.
Well,
this is the thing, right? Nobody measures the performance of their self-managed super because it's probably done very poorly. Yeah. But it's given them some great tax benefits, and that was I think the key driver. Look, in New Zealand, there's a couple of challenges, right? We generally have fairly low financial literacy. KiwiSaver has been really good to get people interested in investing. 3.3 million people have got an account, so they're probably paying attention. The barbecue chat now often comes around to KiwiSaver. So I think it's really good from an education point of view, but most people, they don't have the expertise to be able to make those decisions themselves or the time. I mean, it takes an awful amount of work to make decisions around what's your exposure, what companies you want to be in. And sure, for those that really want to do it, there are some really good platforms now that you can pick your own stocks, and that is controlled for the same reason as that, probably wouldn't trust most people to be able to build their entire portfolio because they might have a pretty skinny retirement at the end of it if they haven't done a good job. So look, primarily KiwiSaver funds are well-diversified managed funds with exposure to lots of markets and lots of different securities, and they're being run by professionals. And for the main, for the core membership, that's appropriate.
Yeah. I think about it a little bit like the self-driving cars and going, people want to have control of the steering wheel opposed to the probability you'll be safer is like substantially higher.
I've been in one of those.
Oh, really?
In the US. A Waymo. It was unbelievable.
Yeah.
And I never felt worried or scared, except for one part. We came up to a roundabout, and for some reason it just accelerated around the roundabout randomly. But going there, traffic lights, and I felt completely safe. And I didn't have to have a conversation with a driver I didn't really want to chat to. So it was good.
The Uber driver being like, yeah, mate, this is my real thing. I've got this new business I'm working on.
I'm actually a fund manager on the side.
Whatever.
Right. I've got some stock tips for you.
If someone's sitting in that car park, they're sitting in those default funds, what are the things that they should be taken into consideration when they're looking at a fund manager?
Yeah, so if you don't choose, if you're just joining KiwiSaver new, you're going to be defaulted into one of the 6 default providers, and they're set up by the government or approved by the government to be a default provider. They've gone through a process. They tend to be lower fee. A lot of them nowadays, because of the lower fee, tend to be a more passive investment approach. And look, there's a clue in the name around default, right? You're defaulted there. It's kind of was intended to be a parking space for people until they could do some research and decide who they wanted to be with. So if you haven't chosen your provider, you're in a default fund or a default provider. They're all balanced funds. They're all reputable companies, but it may not be the suitable provider or fund for you. So, do your research. Think about where do you want to be? Probably starting with ultimately investment performance, right? So the Morningstar report comes out every quarter, has a great summary of the performance of all providers or most providers. Start there. So look at the track record of the providers. That's after fee returns. So don't get too caught up on fees and, is it low fee? Is it active? How much are the fees? Look at that performance after fees. Consider things like the service of the provider. Can you phone them up and have a conversation with someone, or is it only a chatbot there? And look, that might be fine when things are going well, but during COVID, our phones were ringing off the hook. People wanted to talk to people. It's their money. They get quite worried. Can you get access to advice? Are the interests of the portfolio managers aligned with the investors, i.e. do they have their money in the same fund? how do you get your information about your KiwiSaver? Can you see it on an app? Is it easily accessible? Can you see where your money's invested? Can you see the performance easily? Is there advice available either from the provider, or can they put you in touch with an advisor? Lots of things to consider.
So, Murray, some of the levers we can pull are the contribution level, the fund we're in. Say if we're contributing 3%, if we do an extra percent, how much of a difference does that make?
Yeah, look, literally it can be tens to hundreds of thousands of dollars, depending on your income and other things. There's lots of great calculators out there. Most KiwiSaver providers will have a calculator on their website. You can go and plug in your own personal numbers and see what this looks like by age 65. So I plugged in an example on our calculator on our website. I looked at a 20-year-old in an aggressive fund. Let's say they've already bought their home or they don't intend to buy the home. If they're contributing 3%, they get their balance by age 65 to $452,000, which is a reasonable amount. It's a good amount of money, right? If they can contribute 4%, their balance gets to $525,000 by age 65. If they can do 6%, $670,000, 10%, $960,000. So it's material. Each 1 or 2% more you can contribute over time with the power of compounding and great returns on top of that can make a significant difference to the quality of your retirement.
Yeah. And then you kind of overlay off the back of it as well, conservative funds versus aggressive funds, making sure you've picked a provider that has a good track record over a long period of time, making sure that they align with your values. All of those things really add up when we're talking about, you go 1 or 2% or 0.5% and you're potato, but you roll that out over decades and adds up to a lot of money.
Well, the myth is all KiwiSaver providers are the same, so I'll just stick with the one I've been defaulted into. That couldn't be more wrong. There is a lot of choice. Look, there's 25 odd providers, over 300 funds, so it pays to do your research and choose the right one for you.
Cool. So the obvious question, Murray, is if you're going, all right, tens of thousands, hundreds of thousands by making an active choice of who my money is invested and the level of contributions, where do I start? And where do I start in terms of educating myself? And then also, if I want to go and have a chat to somebody at Milford, how do I do that?
Well, it's really easy, actually. And one of the other beauties of KiwiSaver is they've made it easy to transfer between providers, and it takes a maximum of 10 days. You don't have to go and have an awkward conversation with your existing provider to say, hey,
it's not me, it's
going
you.
Into your bank or somewhere else and go, I want to move to another provider. Can you do that for me? In our case, you go to our website. We've got a page on there. You can do your research around our KiwiSaver offer, and then we've got a button you can click join now or transfer now. Literally takes less than 5 minutes. We just need your name, address, your IRD number, and some ID, your driver's license or your passport number, and we do it all. And in fact, it all flows back through the IRD. And so you'll get a notification from us when within 10 days we've got your money from the IRD. They've taken it back from your current provider, and it's in with us. So it's very, very easy to transfer between providers.
Yeah,
nice. And if you're also looking for more information, those Morningstar quarterly reports are really good, and sorted.org.
Yep, that's a really good site.
Has a really good comparison. I think it's fees, performance, and service are the main things.
Correct.
And then you can filter them all.
Yep.
It's not you, it's me, eh?
Yeah. Call your bank, break up with them.
Yeah. But I tell you what, it is you if you haven't subscribed to our YouTube channel. So make sure you do that. Give us a review, give us a like. Much love to Partners Life for sponsoring this episode. Murray, thank you very much for your time.
Been a pleasure. Thanks, guys.
We'll catch you next time.
Cheers.